Hi everyone, this is Ted Bauman of Banyan Hill Publishing. Next Halloween, I think I'm going to wear as my costume an inverted yield curve. That's because clearly it scares the heck out of a lot of people. What's an inverted yield curve? Well, I'm going to talk about that today in a little webinar that I thought I would share with you. Remember, an inverted yield curve is one of the many indicators that we use to try to assess where the economy is and where it's heading. But it does have a particular reputation as being absolutely associated with one thing that nobody wants to see in the near future, a recession. So let me explain what an inverted yield curve is and why you should be concerned about it. Okay, let's talk about the yield curve and why everybody is freaking out about it. Well, to begin with, a yield curve refers to the relationship between interest rates on long-term and short-term treasury bonds. Treasury bonds, of course, are what the government issues in order to raise money, particularly when it spends more money than it takes in taxes. So this is a very important part of the financial life of the country. Now, normally, long-term bonds pay higher interest rates. People generally want to get a higher return if they're going to put their money aside for a long period, because who knows what's going to happen over 30 years. You might get a better opportunity. So generally speaking, long-term bonds pay higher interest rates than short-term bonds. A yield curve that's inverted simply means that long-term bonds are paying lower rates than short-term bonds. And the reason why everybody's freaking out about this is because historically, an inverted yield curve has almost always signaled that a recession is coming soon. Now, let's take a little bit of a dive into the relationship between bond prices and interest rates, because it's really the underlying mechanism that makes all of this work. Bonds are like any other asset. The greater the demand for them, the higher their price, and vice versa. So when lots of people want to buy bonds, the price of bonds goes up. When not very many people want to buy bonds, their price goes down. But the critical thing about a bond is that the higher the price of the bond, the lower its yield. Here's what that means. When the federal government sells bonds to cover its budget deficits, it's offering to pay investors a fixed amount of money in the future in exchange for a smaller amount of money today. For example, if the government sells me a bond for $100 today and I pay $95 for it, that bond has a 5% yield. But if demands for bonds increases, I could sell my $100 bond, for which I paid $95, for $97. That implies that the bond's yield has now decreased to 3%. The opposite could also happen. I could try to sell the bond because I need to raise money, and somebody might only offer me $92, which means that the bond yield has now gone up to 8%. So basically, bond yields are set by investors buying and selling bonds, mainly treasury bonds, in the open market. Because remember, when the government issues a new bond, that's not the end of the bond's life. People trade these bonds back and forth to each other all day long. Now, the yield curve shows the relationships between bonds of different maturities. The maturity of a bond is how long before the bond is repaid by the government. Now, short-term bond yields, how much interest rate you get on, let's say, a 1 or 3 or 5 or 6 month treasury bill, are mainly determined by the activity of the Federal Reserve when they set interest rates. That's because investors expect to get at least as much yield for a short-term bond as they would from putting their money in a bank account. On the other hand, long-term bond yields are determined by the market's expectations of economic growth and inflation and future interest rates. So for example, over here you can see that here is where the bond rates are basically determined by what the Fed's doing. Whenever Chairman Powell indicates that they're going to change interest rates, this is what is determining what these rates are. But over here, the longer term, when you get into 5, 10, 15, 20, or 30-year bonds, that's all based on where investors think the economy is going to be in the future. Now, a normal yield curve slopes upward like this black one, right? So as you can see, the yield on a 1-month treasury bill is about 2%, while the yield on a 20-year T-bill is almost 5%. Now, this is historical. This is not today. You'll see that it's based on 2005 and 2007. But this is the normal state of events, like basically that you would see that in the short term, people are expecting a smaller yield, but in the long term they expect a higher yield. An inverted yield curve means the short-term yields are higher than long-term yields, like the red line. So here what you can see is that the short-term yield is over 5% and the long-term yield is below that. Now that's what we mean by an inverted yield curve. When the left-hand side of the curve is higher than the right-hand side, that's an inverted yield curve. Now note the date on the inverted yield curve, December 2007. And we all know what happened in 2008-9, and I'll talk a little bit more about why that is such an important relationship just now. Why does the yield curve invert? Well, when long-term rates go under short-term rates, i.e. an inverted yield curve, it means the market is expecting long-term economic growth to be poor, right? And this generally happens at the end of a Fed rate hike cycle, like the one that we're in right now, when rates have increased enough that credit is becoming expensive relative to profits. Now remember that companies borrow money to invest in the expectation that the profits they get will be higher than the interest rate they have to pay on any borrowing that they do to fund that investment. So when interest rates get higher than the return on investment, companies stop borrowing and they stop making new investments, and that slows economic growth. That's the critical thing. And in such circumstances, bond investors look at a long-term bond and say, well, I'd rather put my money into a long-term investment that guarantees me a certain rate of return rather than, say, putting money into a short-term bond, simply because the short-term yields may be higher, but they're not going to last. Now, here's the critical thing about yield curves. If you look at the yield curve when it goes negative, like here, for example, before 1980, it went negative. The gray line is a recession. It went negative again very shortly thereafter, another recession. It went negative here in about 1997. Again, another recession came. It went negative in 2001. Again, another recession. Went negative just before the financial crash, big recession. And look where it's heading right now. So this is why everybody's freaking out. They're freaking out because when the bond or when the yield curve is in this kind of territory, right, where it's going below zero, where the relationship between the short-term and long-term interest rates that people are getting on bonds inverts, that is a sure sign that investors are saying to themselves, no matter what's going on in the economy today, we think that in the long term, things are going to get worse. And if that's the case, it's better for us to take our money out of the economy or out of investment and put it aside and wait out a recession. And that becomes a self-fulfilling prophecy, because when people begin to look at these indicators and say, well, this means I need to get out of the economy or out of investment, what's going to happen? It's going to cause a recession to happen. So this is why the inverted yield curve is freaking everybody out, and we are extremely close to it right now. So that's my basic explanation of it. Well, there's my take on inverted yield curves, and as you can see, that is something that has a tremendous predictive power when it comes to recessions. But as I also mentioned, one of the key things about inverted yield curves is that, like anything having to do with interest rates and yields and so on, there's a component of self-fulfilling prophecy involved. So I think the critical thing is to watch what happens in markets on Thursday and Friday, and also for the rest of next week. If the yield curve does invert, if it does dip below negative in terms of the relationship between the two key interest rates, I predict a fairly rapid decline in the stock market. This is Ted Bowman from Banyan Hill Publishing, signing off. Thank you.